Good evening, everyone. How's everyone doing? This is Coach Sean with C3 Coaching Strategies. And as we promised, we're starting Common Sense Back, where we basically talk about all things financial, not just, although I am a business and credit coach, there's more to our financial makeup than just our business and our credit. And so, with all things and using all aspects of our life, common sense. And if you notice, the end of the S is actually a money sign, is really geared towards money and how our financials impact our everyday life, how we can build wealth, and things of that nature, and just be healthy all the way around. And so I've had a lot of different conversations with people regarding life insurance. And I recently was doing a study and I realized I came across this study that said 83% of people who don't have life insurance simply because they don't understand it. And the thing about life insurance is that life insurance actually is a way to actually build wealth and generate generational wealth and establish legacies within our family, but not the way that most of us think. You know, you can actually what if I told you can actually use your life insurance policy while you were living to actually have a very healthy life? And so you might think that what I'm saying is just does not make sense. You've never heard of it. And that's okay. So I just want to thank you guys for just dropping in, joining me. Today I have a very special guest. I have Lillian Tran from Lillian Tran Insurance. It's one of my peers, someone who I collaborate with oftentimes. And so, Lillian, why don't you introduce yourself to the audience first?
Hi, everyone. First of all, I'd like to thank Coach Sean for having me on his platform. And my name is Lillian Tran. I was born in Vietnam. My parents immigrated to the United States in 1980. They left Vietnam in 1980, but we immigrated to the United States in 1982. And as most of you know, Asian parents, they want their kid to go into the medical field because of the job security and the prestige that the medical field provide for us. So that's what they wanted. And funny thing
Wait, but let me just jump in real quick. So I'm sorry. Yeah, because I want this to be more relaxed. So you're telling us that what we probably always hear, and I'm probably gonna get in trouble for this. Well, all Asian families want their kids to be engineers, doctors, or lawyers. Is that what you're trying to say to us?
Yes.
Okay. All right.
So the funny thing is I did go into nursing after high school, but during clinical study, my second year, I didn't like it at all. So I stopped and I told my parents, no, I'm not going to go to school for nursing. So I ended up working because I'm the oldest of 6 kids. So I ended up going to work in the casino. So I worked in the casino for 18 years, a little over 18 years. And then I got married, have a kid. And after I had my daughter, I wanted more time and flexibility. So I went into real estate. And then in 2016, I moved my parent over here to help me with my daughter. And then my dad got ill, took a turn and got ill, and he has to stay in the hospital for almost a year. So during that time, taking care of him, I wanted to learn more about insurance and to protect my family, just in case something like this does happen to me and my husband, and so we don't have to go into our saving and pull all our 401k and stuff like that. So that's what I've been doing. I instead of I took a class. I study at night, and when I take care of my parent, I study for the insurance license. And then in 2018, I quit the casino and worked to spend more time with my daughter and take care of my parents. So I've been doing insurance part-time ever since.
Okay. So I heard you say it. So first, forgive me in advance. So you started off, you said your parents want you to be a doctor, lawyer, engineer. You decided to be a nurse, then you stopped doing that. But then you mentioned that you were a realtor, and then you ended up getting into life insurance.
Mhm.
So that is, I just want to use that to say that oftentimes we get steered into particular places for our parents where we told what we need to do, and we end up getting stuck in life. So I'm just glad that you didn't continue onto the path that you were, just stayed in the casino industry, because then you wouldn't be here to kind of share the knowledge that you have today. So the reason that I brought Lillian on was because about a month or so ago, I was meeting with my family at a family reunion, and they asked me to just give a presentation as what we do. Like during our family reunions, we actually have a family business, so we had a family business meeting, but also spoke about ways to generate wealth. And one of the things that I indicated was through life insurance, and it kind of blew everybody's mind, because people don't really realize that you can actually live off of your life insurance. You can generate wealth and things of that nature. So Lillian, that's one of the reasons why I asked you to come on today as an insurance agent, having your own insurance company, was kind of talk to us a little bit about the misconceptions of overall insurance. So I know that, well, let me just start off by saying, let's start from the basic aspect of it. So the basic aspect of it, most people are, I'm going to say, they understand, or they've heard the term. So let's not say understand, but they've heard the term insurance, right? So there's term or wholesale, but there's many more insurance out there. There's universal, which is something that you're going to talk about today. So because I want to make sure that we use this platform really to educate people and to help people understand the importance and how life insurance can actually be beneficial to them, and how they can actually generate wealth. Could you possibly just kind of begin by breaking down the different types of insurance for me?
Okay. Yes, I can.
And do it so that they can understand it. Let's take it between, kindergarten and second grade level, so that everybody can understand. And then we're going to open up, questions. So if anybody have any questions, you drop your questions down, and we'll make sure that we get those questions in the end.
Okay. Thank you, Coach Sean, again. This month is September is an insurance awareness month, as you all know that. There are about 1,000.
I didn't know that. But,
yes, September is in Life Insurance Awareness Month. So that's a great. So this month is a great time for you to bring me on to educate everybody. There are at least 1,000 insurance company out there in the United States, and about 10 of them are less than 10 of them are mutually owned. What mutually owned is the insurance company doesn't answer to, like, they don't make decision based on shareholder. They make decision based on the policy owner. So you want to go with the insurance company that are mutually owned. So they have your best intention, the policy holder best intentions, instead of the stockholder. So let's talk about term life. Term life is like renting a house. So it's temporary death benefit. They have no cash value. It's the most affordable and the most cheapest form of life insurance.
Let's not say let's because mindset is everything. So let's change that word from cheapest. Let's say the most cost effective. Because when people think cheap, they think something that's not really worthwhile, right? Let's just call it what it is. They think that it's garbage. So if it's most cost effective, right?
Yes, it's the most cost effective form of life insurance out there. They have a set premium and a set premium and a set amount of time that you pay into it. So let's say your term life is it cover you from 5, 10, 15, 20. The maximum that most term life insurance cover you is 30 years. So, and it's also based on your age too. The older you are, the shorter term that you are going to get, because they're covering you. So you're younger, so that means you live longer. So that way they cover you longer. So, and then so therefore most of the term life is for those that want additional coverage on top of their whole life policy. That's what they're for. And also they're for those that want that have limited finance, so they buy the term life instead. And they're purchasing this because the term life, and then they add the living benefit to it, so that they have the living benefit side to cover them. I'll go over what living benefit is in a little bit.
Okay.
So
now, is that only, because I know we're talking about term, but is the living benefit, does that only apply to this particular type of insurance?
No, with my companies, they have it. They have it included in the policy, so you don't have to pay anything extra in it into the policy. So they have it on term, whole life, universal life, annuity.
Okay, and we're gonna cover those. So just term, because you said it's like fixed time. So it's kind of like if you're looking to. So I'm gonna spin this back because I wanted to the financial aspect. So like I tell people all the time, we talk about different types of loans, right? So we're talking about like an installment loan. It's a certain amount of time. So it's like a mortgage, right?
Yes.
So you said 30, and typically term life is like a 30-year mortgage loan, typically, right?
Yes. So
There's
if you
a
don't
start
die,
date and an end date.
Yeah. So if you don't die within that 30 year, then the company and you go part way. You just lose all your whatever you pay
lose,
into
so you
it.
just lost
Mhm.
all that money. So unlike a house, you own it. With term life insurance, it's just
like renting a house. So like
so
you
it's
rent.
almost like it's better for you to die doing that. Maybe that wasn't a good joke, but to them it's like with term insurance, you know it's better if you think you're going to die within that 30-year period in order to capitalize on it.
Yes.
Okay, so I know, I'm sorry guys, that was a bad joke. Not a good joke teller. Go right ahead, Lillian, to the next one.
So the next one is whole life. Whole life is the most cost effective and most conservative and the most expensive form of life insurance. They focus more on death protection than cash value accumulation. They have a lifetime protection and they have a highest guarantee. Typically, they have a set their premium is set at issue, and so also they have no flexibility in the premium, so you cannot adjust the premium or the monthly payment. So it's all set with whole life. So, and you can build cash value with it, and the policy will endow. What endowment mean is in the cash value will equal the face amount at age 100. That's what endowment mean. And cash value is guaranteed. The death benefit and cash value can be increased by applying dividend. What dividend is the dividend is the company profit, the insurance company profit that paid to the policyholder. That's what dividend is. So there's with the. Do you have any question, Kosha?
What I was gonna say when you said the whole life. So with the whole life, it's just a set payment amount, and it just continues on for your life, right? So is that like is that the same as permanent life insurance?
It is permanent life insurance.
Okay.
Whole life is
so those two
permanent.
words are used interchangeably. Okay, because I know some people have heard permanent life and some people have heard whole life.
But the way that you can add increase the death benefit and the cash value is by increasing the dividend. That's the only way, that using the dividend to increase it. That's the only way you can do it. Besides that, you cannot increase the cash value or the death benefit. Okay. All
right. So let's get to this third type of insurance here that most people don't even know about, right? That they say 1%, that the 1% typically uses. And if you guys are listening, you're going to understand why wealthy people use this type of life insurance.
Well, there's different kind of the third kind is the universal life insurance. There's different kind of universal life insurance. There's fixed universal, there's index universal, and there's survival universal. So I'm going to go all three of them. Fixed universal life is it offers a lifetime protection when sufficient premium are paid, and also they offer the flexibility of to start the policy, start the premium. And if you want to increase it later, you can increase the premium and the cash value to add more cash value into it. So that's what it is, to increase the cash value. And also they're the lowest form of lowest cost permanent solution as compared to an index universal life and a whole life. And they have lower cash value potential than index universal life and a shorter term guarantee than a whole life. It has a declared fixed interest rate as opposed to the dividend with the whole life.
So is that when we talk about the three different types, when we talk about the guarantee, the index, and the variable, is that pretty much the same thing that you're talking about right now when you're talking about the types of?
No, the crediting strategy is different with the fixed IUL. So fixed index universal life has a fixed declared fixed interest that's credited for your credit for the cash value accumulation. That's what it is. And
so when people talk about the types of insurance and they go guaranteed, index, and variable, what exactly are they talking about? So the fixed universal life is used a declared fixed interest rate, and then the index universal life use a the S&P, the stock market. So they have a strategy that they use to accumulate the cash value based on the stock market. So that's what it is. Am I getting ahead of what you're explaining? If so, I'm going to pull back. It's okay. All right. It's okay. And there and fixed index universal life is the most affordable type of life insurance. Has cash value in it, but it's not used for retirement income with in fixed index universal life. So it's not used for that. But the people, the clients can use it as a loan to borrow against it. That's what it is. And these are for people that require more protection than the term life offer. They want a low cost today with the potential to increase premium later for additional cash value accumulation. That's what the fixed index is for. Okay. Mostly for. All right. So just recap this. So there's three different types of insurance that a person can choose for. There's term life, right? Which we said is like an installment loan, like a mortgage, right? It's 30 years typically. And at the end of it, there's nothing, you walk away mutually. Well, it's not really mutual because the insurance company has the money and you don't because you didn't die, right? Or your family didn't die. Bad way of, not necessarily a joke, but just realistically, that's what happens. You walk away. And then you have the whole life, right? Which goes from the time that you purchase it up until the time that you die. And there's just a fixed amount with that. And then there's the universal life. And in the universal life is actually the type of policy that you can borrow off of it. So when we talk about borrowing off of it, like I've heard people talk about being able to use this type of insurance. There's a lot of different benefits from it. So before I just throw some things out, why don't you tell us what are some of well, let's start with the cons, because we always start with the benefits. What are some of the cons of using a universal type of life insurance? The con is there's not that many con in the universal. It's more for cost effective than the whole life. So it's so that you can fund it like you can add
let's say you want to fund it for 20 year, and the younger you are, the more cost effective it is to buy the insurance. But the older you are, then the more expensive it is. So, but these universal life cover from age 0 to 185. So between those age, you can buy it, and you can fund your retirement off of it too, as well too. With the index universal life, you can fund your retirement, and you can use it for retirement to supplement your retirement as well, income.
Okay. Now, you also mentioned with this type of insurance, you mentioned that your father got ill and
Mhm.
you were able to use this insurance. So there's things out there called riders. Now, a lot of people, because, you know, when I hear that, the first thing that I think of that a lot of people may think about is the Aflac commercial with the duck, right? When you get sick, you get the Aflac insurance. But how are these riders different from Aflac?
Well, Aflac, you have to buy the extra rider in the. Well, my dad, he didn't have this insurance when he was ill, so we kind of like have to pay out of pocket for us. But then he has.
Let's say hypothetically, you had this insurance in place and then your father got ill. How would it have worked?
So he can accelerate the death benefit of it, and use it for a medical bill, or to pay for the nursing care, or to pay even to, if he wants to go back to Vietnam, he can use that money to go back to Vietnam, and pay mortgage, or pay whatever he wants to do with the money. It's not limited. Whereas Aflac, you can only use it, I guess, some of the policy that are like hospital, you can only use it for hospital. And Aflac offer long-term care, so you can only use it for medical stuff, related stuff only. You cannot use it for anything else.
Okay.
And
now the other way that I've heard this insurance, like people talk about this insurance, they talk about like a home equity line of credit, where if you have a home, and based on the equity, you can get a home equity loan, and you have money that you can just borrow off of it, and you can use it to do different, fix your house. You can use it to travel. Sometimes people use it to take extravagant trips. So I've also heard that this is something that people with this type of policy do as well. Is that true?
Yes, you can borrow against it if you have enough cash value. But if you want to use it for retirement later on, let's say you're 60 and you don't want to work anymore, you can use that to supplement your early, instead of withdrawing from your 401k, where they're like performing really well. And then you can use this to supplement that retirement. But the loan that you borrow has to be paid first. So with our company, we have it doesn't charge you anything for that rider, the lifetime income rider. But when you activate it, that's when they charge you. So
okay. So my question here is, if I have, because you know, this is just me thinking financially, if I have this policy, and I set this policy up to go to, you know, to generate some type of, to help establish my legacy, to leave something. My grandmother used to say, in the Bible, it says that you're supposed to leave something to your children's children, right? So we talk about legacy and generation. We talk about that third generation, right? So leaving something. So when we think generational and establishing legacy, we think about that third generation. So I guess what some people may be trying to understand here is, if I have this type of policy, how is it possible that I can borrow from this policy and still have money left over for my kids, for my legacy? Like, what happens to the death? Am I eating away at the death benefit? How does that impact the cash value of the death benefit?
well, if you use it, the cash value will go down. So if you use all the cash value, then the company calculated where they will have a certain amount left over for your beneficiary. So that's to give it to pass on to your beneficiary. So you're not necessarily pulling all the death benefit out of you using using it for to fund your retirement.
So basically what you're saying, and just hypothetically, let's just grab this number, just
Mhm.
say 300,000. I have a $300,000 policy. I can use 200,000 of that policy and earmark 100,000 to be left to my family if I so choose. And I can use that 200,000 to travel the world if I want. I could buy new teeth. I can, I can get mommy makeovers. I can get anything I want with that money. I can even take it out and buy property with
Yes.
it.
Uh-huh.
So I can use my life insurance policy to buy property that then adds to my legacy that I get to leave to them with this
Yes.
type of policy.
Uh-huh. So
Okay.
what that is, if you're using the living benefit where like you're taking a discount, so let's say it's also based on your illnesses, the severity of your illness. So if the insurance offer you the full living benefit cash value when you're sick or when you get sick, then you don't have anything left over for your beneficiary. So let's say you bought $1 million policy and they gave you 500,000. They gave you like $500,000. So that means that you accelerate the whole death benefit. It's a discounted amount, so it doesn't give you, because they have to add the fee and all those other stuff in there too when you're taking it out.
Okay.
So that's why.
Okay. So I got a couple questions from people on the thread. Before I get to that question,
Okay.
one of the things that because we talked about houses. So when you're talking about life insurance, because I want to be clear on this, because a lot of people don't understand, and you can validate this. So when you buy a house, oftentimes you're required to get insurance for the value of that house, correct?
Mhm.
Does that insurance, if something happens to you, pay for that house?
Well, the mortgage insurance, it only cover mortgage, so it cover mortgage. So technically, you're not owning that mortgage. So it cover the mortgage company. It doesn't cover
Uh,
you. Okay.
Okay. Right. Okay. And that was very important. So, because I often tell my clients and just different colleagues, whenever you buy a house, to make sure that you get an additional life insurance policy. But most people think that the policy that they're required to get at signing is a life insurance policy. So I typically tell people, let's just stay with that 300 number, that when when they buy a house, so you buy a house for $300,000, that you also get a life insurance policy in the amount of $300,000. So let's just say 20 years in, you've paid down the cost of that mortgage. Let's just keep it at even numbers. Let's say 150 now. You paid down that mortgage to about 150. The value of the house 15 years ago was 300. Now let's say how we went through that big bust in COVID, which isn't typical, but just say the house is now worth 500,000, right?
Mhm.
You owe 150 on it. If you don't have that type of insurance policy, your family can lose that house if no one's able to get a loan for that 150,000 versus if you have taken out that additional policy in the amount of that house. They have 300,000. They can take half of that, pay off the house, and then they have the 150 in cash to use. But actually, you've left them about 350,000 in
Yes.
profits because the house has now appreciated $200,000 plus the 150 that they have in cash. And what a lot of people don't understand is when we talk about, life insurance, it deals with when we're dying. But a lot of the times you have the banks, they bet on you not having life insurance, and especially these additional types of life insurance, so that they can pretty much wait that 6 to 12-month period and take ownership of that property. So now they have a property that's worth $500,000 that's only owed 150 on it. So they just had a big come up right there, right?
Yes,
So,
that's what it is.
So in that type of situation, what type of insurance would you recommend someone to get for if they're just getting it to secure the length of the mortgage? Would that be a term, or would that a wholesale, or would that go back to being a universal type of life insurance?
It's dependent on what they're looking into. So let's say but the universal life would be the best option for most clients too. I would recommend universal life first. I would look at the universal life product first, because it offers death benefit protection in there. It offers retirement in there, and it offers illness. So let's say you get ill, you get sick. So it offers all three of those in one component. So
now you mentioned the S&P with universal. Is that a tax write-off as well?
This one, insurance is so when you get the benefit, it's not taxed on. Okay, so even the index universal life is not taxed when it's passed on to your beneficiary. So
Okay.
even you can use this as a tax-free retirement too. So it doesn't, and you cannot outlive. So if you fund it correctly, you can live to 120 and still be able to withdraw from it. Even if, like, let's say you put 500. Let's say you get $1 million policy, and you fund it correctly. Let's say you funded about half of that. So, and then you take out like about over $1 million withdrawal, but you're still building the cash value because it's compounded. Your money in the index is compounded on top of from interest. So
so pretty much it's a win-win, because I asked you the pros and cons.
Mhm.
And so we talked about the cons, and then we went through and we talked about the pros. Let's hit a couple. There's a couple questions here. Let's hit a couple questions, and then I want to hit on a couple things that you talked about, like from a generational aspect and being able to establish that generational well. So I have one question here. It says, so if you're in your mid-50s, what would be the best and affordable insurance to have?
Well, we do it based on suitability and affordability. So I would have to.
So what is suitability? What when you say suitability, what exactly does suitability mean?
So it's based on how much they can afford. So let's say let's say they can afford, they want to buy like $1 million insurance, but their budget is only like they can only get like a $500 policy. I mean,
500,000.
yeah, $500,000. I cannot sell you the $1 million just because you want $1 million, because later on there's no point in it, because you're gonna lapse the policy and it's not gonna work in your best interest. So I have to sit down with them, and then run the number with them and make sure that their payment is it matches with whatever they want to buy. So that's what it is.
Well,
that's what it comes down to.
I'm glad you said that, because in my community, because oftentimes we talk about the difference in community. You talk about Asian time, I talk about Black time. We just time starting on time, but there's a lot of different myths and misconceptions, right, within our different communities that we have to be really realistic about. And a lot of times within our communities, one of the biggest reasons that people don't have insurance is because they say, well, they can't afford it. And what if I sign up for an insurance policy and then I made 75% of the payments and then I miss a payment? Now I've paid all that money and I'm not getting anything in return because I just simply can't afford it. So to hear you say that one of the things that you do is you sit down with people, it's kind of like when you're applying for a house, they want to go through and say, okay, can you really afford this mortgage before we give you the loan? You may make enough, but can you afford it? Or with a car, how much can you really afford to make each month? Although, y'all, I just want to say, sidebar, car industries really don't care if you can afford it. When you're in the home buying field, underwriters pay more attention to that. So that's a good thing to know, because like I said, that's one of the biggest pullbacks from people within our community is they get into a situation and they're not able to pay it and they've lost the money. So outside of doing the suitability, is there anything like, say COVID hit and you had a lot of people who just weren't able to make payments? Did a lot of people lose their policies, or are there things set in place when you're using a universal life to make sure that those policies stay in place when situations like that happen?
So with the universal life, you have the flexibility. So let's say you don't have, you can decrease the amount of payment but down. You can bring the payment down, and then or you can decrease the face amount too, so that it could fit into your budget. And as when you build up when you will get your income, when you make more income, you can increase that death benefit and the amount, and increase
Okay.
your policy. So because it gives you the flexibility with the universal life.
All right. And let me know in the chat. If that's your question. Let me know in the chat if we actually answer your question, because the thing that we want to do is we want to walk away here with everybody having a firm understanding, because we want to take that number down from 83% to a lot lower number. We want to make sure that we don't have a whole lot of GoFundMe's out here because people just don't understand and are afraid. So knowledge is definitely power. Another question we have here was, how long do you have before you can pull money from it?
So with the universal life is 10 years. Okay. So, and with 60, so you have to be 60 years old and you have to fund it 10 years. So in the 10 year.
So I can only use this policy once I can only use the cash value of the policy once I turn 60.
No, to retire, for retirement, you can.
Okay.
But the let's say you get chronic and critical injury stuff, that you can access the death benefit for the 30-day afterward, after you become ill. So let's say you buy it today and then a month later you get into a car accident and you cannot work. You can accelerate that death benefit and use that for your monthly, if you cannot work for 90 days, you're able to accelerate that benefit and use it as income to pay for your mortgage, to pay for your anything you want to pay.
So it's almost immediate access.
Mm-hmm.
And then for retirement, you don't have to wait until you're 62. You actually can just wait until once you hit 60, you can begin getting that money and using it towards retirement.
Yes.
Okay. Now, what about for travel? Do I have to hit 60 as well? if I want to like take 3 months, 90 days and, hit all the continents, how long do I have to wait? Do I have to wait until I'm 60 for that as well? Or 30 days? Is there a particular time frame?
What do you mean travel?
I mean, I said I want to pull money out. I want to use the cash value of my policy.
Well, as if you build cash value, you have the cash value in there. You can take it out anytime you want.
Okay, so as long as I have cash value on. So how long does it typically take to build cash value on a policy like this?
It depends on how you fund the policy. So let's say you fund it. We have paying like 7 pay, so 7 years. So you either pay it all at once upfront, the whole policy all up at once. We do the numbers, so it sometimes is more affordable. And then also you can fund it monthly, or you can fund it up to, so like with my policy, I do it for 20 years. So but I will have my insurance will have it for the rest of my life. But with mine too, because I am I was under 40 when I buy it, so I was able to add another rider on there where it increased it every year, like a 15%, the 5, 10, 15% to get up to that $500 $1 million policy that I want.
Okay. So here's a couple of different questions. So just not about the universal aspect. And there was a question in there about someone that wanted to know what is the lowest possible, and I'm not sure if you can answer that, what is the lowest possible monthly payment someone could make for the universal life?
Well, I have to run their number. It's dependent on how much they want to buy and what their
That goes back to that suitability. So
Yes.
what we're going to do is we're going to make sure that we put your information in the thread as well, so that you can give them that personal information for anybody that wants to get an idea of how much it will actually cost them, based on, because you're saying it's based on what your age, what you want, just typical insurance stuff, right?
It's based on your age, your health.
What about your health? Does your health?
Your female, your health rating, the health rating. Females, technically, female are more, it costs less than male for to insure a female, because female live longer than male. That's what it is in terms of insurance. And if you're a smoker and non-smoker too, and there's different rating that we look at too, and then we can give you the highest rating. But then when the insurance pull your medical record, they come back, they can give you another rating. So it's all depend on the insurance company too.
So what if you already have a chronic illness? How likely are you to be able to qualify for this type of insurance?
So let's say you're diabetic, correct? Let's say you're diabetic. If it's controlled, then you're likely to qualify. But if it's not under control, then you won't be qualified.
Okay. So I have another one for you, because here's a big thing. People with mental health, that if they actually have mental health, or like say they have a chronic illness and they're being prescribed something they call off-shelf label. I know my pharmaceutical friends hit me later because I probably got it all wrong. But a lot of times what I'm trying to say is they will take a medicine that may be used for mental health for say migraines, right? Or to control, people who are diabetic. And then so when your list of medications come across, then a lot of times people get flagged for mental health. And so with life insurance, which is also a big deal within our community, people, we're trying to get people to embrace, mental health, to get the treatment and things that they need. But how are people with mental health, or people that have been provided medicine, off-shelf label mental health medicines, how unlikely or likely are they to be able to get approved? Or, are there different steps that they can do to kind of get around that red tape?
There is the policy that cover that too. And right now we're coming out with, I cannot say it yet, but
okay.
But we're coming there. A lot of the insurance company are recognizing that mental health is an issue in the United States. So they're coming out with policy that cover that as well too. So
okay, great, awesome. That's good. That's good to know. Like, that's groundbreaking. Y'all just heard some stuff that's not even out yet. Like, that's groundbreaking, because that's a big issue, especially post-COVID, because a lot of people who had mental health issues didn't realize that they had mental health issues until they went through the process of being isolated and all the different things that people experience just with COVID alone. So, so my question, yeah, I got another question here. Just popped up. It says, if you have mental health issues that you're medicated for, can I get coverage? So currently, so I know you said some things are coming out, but currently, is there something in place that if I'm diagnosed, make sure I'm reading that. Yeah, that if I currently have mental health issues, that I can go and get a life insurance policy.
We can try to submit the policy and it will come back. It will come back, but maybe they will write the mental health issue out of the rider. They will add a rider in there where they will cover that mental health issue. So That's what it is.
Okay. So you can actually, what you're saying, if I'm hearing you
Mhm.
right, then you could get a policy, but you would have to add a mental health rider to it.
No, the insurance company will add a rider in there where they will cover that mental health issue.
So is there any type, because so that's a big thing. Like, so say for people that are listening that may have kids or even themselves, and they want to insure their children who may have mental health issues, or them themselves may have mental health issues, and they want to insure themselves so that their families can be taken care of. What's out there for them, whether it's term, whole life, or universal, or is the answer just
I will
what's
get
the
back
answer?
to that. I will get the answer to that question and
Okay.
get back to you on that.
Okay.
Because right now I can't. Technically, I cannot say nothing.
I got you. I'm putting you on the hot seat, and
Yes.
I'm asking you questions that you can't tell me right now because you already said, Coach Sean, it's coming down the pike, and I can't say nothing, and I keep pushing. Okay, I'm gonna stop pushing. But thank you, because that is good to know. That's something that
Once I get the answer,
really,
I will move forward it to you.
Awesome, great. And then what we'll do is we'll add it to this thread, and then we'll take everybody who chimed in, and we'll make sure that they get a hold of that.
Okay.
So when we talked about this, we talked about the three different, just to recap, we talked about the three different types of policy. We talked about why that cash value policy tends to be the best policy and why wealthy use it. But one of the things that we didn't say, that the reason why the wealthy like this is because it's my understanding that this policy can also be passed down from generations.
Yes. So all the life insurance can pass down to the next generation. Well, if you pass away, it will pass down to your next generation. So we
talking about the money or the actual policy?
The actual policy can pass on to your next generation. So
really?
There's survivorship policy where you can pass it down to your let's say the survivorship policy. It insured two people. So that's for a husband and wife, or
wife and wife. Let's be all inclusive here now.
Wife and wife, husband
Okay.
and wife, husband and husband, a grandparent and a grandkid, or a father and a kid, or father, or a parent and a child. So let's say the child is uninsurable. Okay. So the parent can buy that policy and add the child to the policy as a second. So the parent died, the child take over the payment, and then this one they can pass that policy down to their kid. So after they take the payment, so that later on they can pass that death benefit down to their kid.
That's the loophole. See, when we talk about loopholes, we talk about money. So the great thing, not the great thing, but the thing that I love, right, about learning, is that
back to the mental health policy. Let's say you have a mental health and your wife doesn't have a mental health. She can get this survivorship policy, and then it only get the person that's healthy, the policy, so she can add you on there, and then so she can get you covered. If anything happened to her, you'll be covered. You take over the policy. You understand?
That's the loophole, and that's what I'm saying. When we talk about financial like nuggets and gems, I don't know if y'all just caught that, right? But a lot of times wealthy people use these loopholes that we don't know about, and like my mind is really blown because I never knew that. Like I never knew that. Like we're sitting here talking about how do you get insurance for people with mental health issues or people who have chronic illnesses, right? That it's too late. Like, it's too late for you to get a policy. But now you just said this policy out here, survivorship, right? That's what it's called, survivorship policy, that I can go out and I can get for, myself, for a family member, a friend, whoever, and set this policy up. And realistically, if I do it right, I can say, hey, listen, I'm going to get this policy for you because you can't get it. And you just need to pay it every month. It's not even something I technically have to pay, but I can now assist a marginalized community be able to get the services that them and their family need, so that they're not left in a bad situation.
But
once it
the
happens.
what the survivorship policy is, it does not include living benefit. Okay, so let's say when one of them died, then the other person can apply for living benefit, but it does
Okay.
not have living benefit in there. So that's the only
Okay.
downside of
But
it.
that's better than no insurance at all, right?
Yes, that is better.
Because a lot of people have this mentality that, well, I don't need insurance because, well, when I'm dying, I'm no longer here, and that's the other person's responsibility. Like, that's a big thing within communities across the board. We see that
No,
people
because
that
you
don't have life
live in
insurance.
no, you live in well, that's with the Asian community too. They're like, because when in my parent generation, they didn't think about buying insurance or whatever, because they're like, well, I work hard, I save, so that should be enough. And that's it. They don't think about passing that down to their kid, or what if they get sick. So they don't think about how, let's say they pass away, then their kid will their kid or their children or their wife, what about what who's going to protect them, what and stuff like that. They don't think about that. So
Yeah.
this is a great way to think about it, so that your family is able to live the way that they're living. They're not have to downgrade everything and move out of the home that you buy and live in. That's what it is.
And it's also a great way to cover your grown kids. I mean, how often, oftentimes we talk about, you have kids, the term life, whatever, you get these policies for your kids. Most people get term life because that's what they're sold, especially in our marginalized and minority communities. That's what we're sold. We're sold term life insurance. And we don't know unless we know, right? So it's not until we learn that there's something else better for us that we can actually do better. And so, like, the whole purpose of this was to kind of educate people on life insurance and how you can leverage your life insurance policy, just like you can leverage your credit, right? We talk about leveraging your credit. You have good credit, you can leverage your credit to make money. You can actually do the same. You can leverage your life insurance to make money,
Yes.
and leave a generational legacy. We talk about leaving a legacy and not just leaving, $50,000. I mean, like that example that I use, if I can take a policy like this, I can borrow off of that policy. And maybe I have 3 kids, I can borrow off that policy, buy 2 more houses. I can potentially, and then put insurance on each one of those houses. I can potentially, if done and structured right, I can leave each one of those kids 3 homes.
Yes.
And I can do a survivorship type of insurance, right? That then passes down, maybe not to my kids, because now I left them homes, but I can now leave them to my grandkids. So, and those are the things that nowadays that we're looking at. Hey, 3, 4 generations from now, will they know who we are? And is that important? And to some people, it's not important, because some people still have that mentality that, well, I'm no longer here, so it's not my problem. Hence, we see all of these GoFundMe. But, the biggest deal is, I mean, like, mind blowing, just being able to have a life insurance policy that we can use while we're living, because most of us say we're not going to be here, but I can use this policy while I'm living and still take care of my burial expenses and still use it to make money and benefit. So my last question that I have, unless someone else has a question, and I'm going to let you close this out. So we talked about different age groups. So oftentimes we say it's best to buy an insurance policy when you're young. And so most people, we get to 50, 60 years old and we're like, well, we're learning this information. We got a hold of this information. And it's like, well, I'm too old to really take advantage of it. So what is the ideal time to maximize, and what is the absolute, like, if I'm pushing it, what would you say for somebody that wanted to do a universal this type of insurance plan? What age? What is that? I know you said 85 is where you'll insure up to, but listen, we talking to This is family. Everybody that's on here, listen, this is like family. Like we taking care of family here. That's what we do. So what would you recommend your family, your cousins now? That's what we call our cousins now, your aunties now, as the last age to get this type of policy. If they're really pushing it, like what would you say, draw the line, like, no, I wouldn't recommend it because this just wouldn't be good for you? What is that age?
Well, if you're under 50, I would recommend this policy, the Universal Life, because it has a lot of benefit to you, and you have the 10-year period where you can earn cash value within the policy if you fund it correctly. It's going to be, if you're between 40 and 50, is more, you're more you're more established, where you have a higher income, so you're able to fund that policy too. And most of your kids are all grown up anyway, so that way you have more flexibility in that area to choose the premium that you want and the benefit that you want in there. And for people that are 70 and 80, it's based on their health too. Would be going through with their health and why they would want this policy as well too. Whether what they want out of this policy, because we would recommend final expenses for some of those, anybody that are 85 or above. 80 to 85 and above, most likely I would recommend final expenses product instead. So, but it's also based on their suitability too. So I wouldn't recommend like stuff like that. So I would have to sit down with them and see what they can afford and what their budget is. I wouldn't sit down. I wouldn't go in here and say, oh, I can guarantee you this, but I can't do that.
And I appreciate that, because a lot of us have elders who, I'm sure we can go back and name some of the elders. If we go back and look at their life insurance policy, they have policies for like 30, 40 years that they're still paying on that are like worth nothing. And at this point, it's like, take the money that you're paying every month and just put it in a savings account and put it towards your burial. But you indicated final burial expenses. Like that's something else. Like you mentioned survivorship, you mentioned final burial expenses. Those are things that people don't mention or talk to us about, right? They sell us additional policies. You know, you hit 65, 70, that policy has elapsed. So you know what? Let me sell you another 30-year policy.
No, we don't do we don't do that. My company don't do that. We do based on suitability, and we sit down, we talk to the client, see what their need is. So what your need is based on what we want to sell. So we just don't want to make the commission only. We want to protect middle Americans so that everybody's protected. We don't want to like have them the GoFundMe. A lot of people, I see a lot of GoFundMe too with my friend and stuff like that. And that's not how we want our kid to grow up in a GoFundMe environment. So.
Well, I have one last question. Somebody just texted me this and they wanted to know, when you pull out the cash value of the loan, is that money taxed?
It's not taxed. So if you borrow against your life insurance policy, it's not taxed. And if you pull it out, if you pull it out over a certain amount, then it will be taxed. But no, it's not taxed. But you have to pay a fee for it.
Okay. And then you just kind of like a home equity loan, and then you just kind of keep paying it.
You pay interest. It's like borrowing money. You have to pay the interest. So
okay. Awesome. Well, I don't think I don't have any more questions. That somebody has any more questions in the thread, just drop them in real quick. If not, what we're going to do, Lillian, we're going to make sure that we put your information in the thread so that anybody that wants to actually have a suitability done for, or just to, talk more to you in depth about their situation and about life insurance in general. Once again, this is more because we said that we have that 83% of people who say they don't have life insurance simply because they don't understand. And we talk about knowledge being power. So we want to make sure that we empower them, that we educate them. And so I thank you for coming on. I thank you for your time. And once again, educating us. So any final words you want to say before we close out?
Well, there's we also do child education funding too, where, like, you know how the 529 plan, the state plan.
Now, is that a Florida only plan, or is that everywhere?
No, I think there's a few states that have the 529 plan. So what the 529 plan does is if you're applying for financial aid, it will limit you because it's based on your income. But if you fund the policy, if you use an Index Universal Life to fund the policy, it does not limit you on financial aid or scholarship. So, and you can use it for anything, not just only for education. So let's say you have your grandkid want to go college and they get a scholarship later on, and they had a 529 plan, and they don't use that money for scholarship for college. And if he use it for anything else, it will be taxed on for the. But for a life insurance policy, he has death protection. He has living benefit protection to protect him in case he has some sort of illness, and then he can use that money for retirement. So it has all three components built in, and it's not taxed on it.
So in essence, what you're saying is like how people buy into the 529 plan here in Florida, and then their kid decides they don't go to school, then they can't really access that money. Where with this particular plan, that money is still there. They can use it for whatever, maybe opening up their own business if that's what they want to do. All right, that's awesome. I mean, so there's a lot of different things out there that we just don't know about. And then maybe we'll have to bring you back and we'll talk about, some of these other hidden gems that we just don't know about. I mean, because that's crazy. And especially when you talk about the mental health thing, we definitely want to bring you back. So any other final words you want to?
So, but
tell
like
us where we can reach you. We're going to put it in the chat, but tell those people that are listening that may not go into the chat, tell us how we can reach you.
Well, you can reach me at LillianTranInsurance.com. Lillian is spelled L-I-L, one L only in the middle, okay? L-I-L-I-A-N, Tran, T-R-A-N, insurance.com. Or you can reach me on my Facebook. It's the same thing, LillianTranInsurance.com. Or you can give me a call at 813-808-9373. If you want a consultation, a free consultation, I do that. I give free consultation too.
Okay. And then also what we're going to do is we're going to drop a link into your, I make my calendar available to my clients or just people that want.
I have Calendly too.
We're going to drop your link in there as well so people can get some more detailed information and find out, what works for them. So listen, y'all, I just want to thank y'all for taking the time and tuning in. This is Coach Sean with Common Sense. Like we said, we want to look at with common sense, the purpose is to take every aspect of our life and make it better. And one of the things that we don't realize is that our financial impacts every aspect of our life. So we want to dissect that and tell you how to live a healthier lifestyle, right? All the way around. We want you to be mentally healthy. We want you to be financially healthy. And we want to help you build those long-lasting legacies that you can leave on so that in the third, fourth generation, people actually know your name. So that is the point of Common Sense. So I want to make sure that you guys share this video, tag your friends, share it with somebody that you don't know. Like we said, 83% of people don't have. So I guarantee you that y'all know somebody who does not have insurance simply because they don't understand it. So share this video with them. Get in touch with Lillian. And once again, stay tuned in. Next month, we're going to be meeting with a very special guest. We're going to be talking about how money impacts our mental health. So y'all stay on the lookout for that. And if you think that your finances does not impact your mental health, you're wrong. And we're going to have a conversation and break it down and tell you how to rebound. Because that's we're going into the holiday season, y'all. Listen, y'all money going to start messing with your mind for real. So we're going to do that October the 19th at 6:30 right back here Facebook Live at Coach Sean. So thank y'all once again. Have a blessed day. And you know what I always say is this: whatever you do, be intentional about the things that you do. So be intentional about having a great day, having a lasting legacy, and spread love and knowledge.
Thank you, Coach Sean.
You're
Good
welcome.
night.
Thanks once again, Lillian, for joining us. And thank you guys for tuning in.
Thank
Have
you.
a great day.